Andrew Holland, Chief Executive Officer at Avendus Capital, is joining us on the show now. Hi, Andrew. Good morning to you, and thanks a lot for joining us today on Bloomberg Quint. Andrew, what have you made of the recent correction that we've seen in the Indian markets? Will you use this opportunity to buy on dips, or there is more correction which could come by?
In the very short term, there could be more correction. I mean, the worrying thing is that, despite, say, yesterday global markets were very strong, our market, fell again. So we kind of decoupled a bit from the global, the global kind of rallies in the past month, actually. And that's all back down to the banking system, and I think the problem with what's happened at PNB is that we don't know if there's any problems anywhere else, and I think that always kind of scares the market. If they don't know something, then they'll sell first and think about what to do next once the dust settles, and I think that's the pressure that we're seeing for the Indian markets at the moment. And if you couple that with what's happening globally, where I think the resignation of Gary Cohen is quite a big negative to my mind, because from what I read, he's resigned on the basis of tariffs being introduced, but it's probably just not that steel tariff. It's more to do with maybe more tariffs which are going to be, or protectionism by the US which is going to come in, and that I think will spook the markets a little bit more going forward than probably meets the eye of just someone resigning. So I think global markets could be in a bit of pressure as well. So that will exacerbate what we're seeing in India as well. And obviously, if there's a risk-off trade, then foreign funds will quickly hit the exit as well on quite a number of their larger holdings.
Andrew, in fact, I was reading one of the reports which did suggest that if the tariffs are extended to gems and jewelry, or even to the pharma space, basically the export-oriented sectors, there could be more pain for India, because so far steel and aluminium may not impact so much, but considering the prices are determined globally for these commodities, that's one factor which could weigh in on all of them. But Andrew, I'm just sticking to the metals space, because we've not heard anything outside metals right now. In case if US goes ahead and imposes tariffs on steel and aluminium, though India doesn't export too much, but if that happens, do you see the prices rising globally for both these commodities?
I'm not sure that would happen, because where do those exports which were going to US go to? So there actually could be some dumping by companies or countries just to kind of unload that excess stock, which can now not go into the US. So I'm not sure I'm a buyer in the fact that prices go up. If anything, I think prices could go down. So that's the upshot of that. I mean, all the reports I've seen have said it's kind of pretty neutral. Trump is negotiating really for NAFTA. So there's certain countries that definitely get hit, which is Canada, Russia, Europe, and South Korea. But I think there's a wider implication, because everyone's saying, okay, China's okay, but China exports to someone. And if you all of a sudden find that they can't export because that consumption now, say in Europe, is trying to be consumed in Europe rather than to the US, then that just leads to pricing pressure. So that's my concern on the metal prices. But overall, I think it's what will worry the market is not just that; it's what's next and who's next, and whether the European Union and China will do something in terms of retaliation on this. And if that happens, then we get into a protectionism / trade war, which I don't think anyone really wants.
In fact, one of the reports suggested that in one of the meetings by Gary Cohn, he highlighted if US goes ahead and imposes tariffs on metals like steel as well as aluminium, that could lead to higher input prices for downstream companies which use these products for their final products. But I'm going to shift focus to the IT pack now. Andrew, if I have to look at 2018, markets may have corrected, but one space which has been outperforming is the IT pack. The Nifty IT on YTD basis is up nearly 10%. Have you missed the bus here? Do you see any opportunities at these levels?
So we moved our stance about 6 months ago from more negative to neutral because valuations were actually looking more attractive to us. And whilst we're not saying that you're going to get to the growth levels of years gone by, we think that kind of the worst is over. And it's in these markets is a place to hide. And at some point the dollar will get stronger after a lot of this kind of trade war kind of problems kind of play out over the next few weeks. So that probably augurs well for a rupee to depreciate from here. And anyway, I think the rupee will probably depreciate because I'm not seeing that the tax collections are so great at the moment, and I think the fiscal deficit's going to come under a bit more pressure. So I think the rupee will depreciate, probably to 66, 67, and that will give a better fillip for the IT companies overall, and maybe that's what the market's trying to price in at the moment.
Andrew, good morning. What about banks? They are now in the eye of the storm for other reasons. PSU banks were always there, and we of course learned that the government will get back to the drawing board on the PSU bank recap plan. But this whole private banking stocks, set of stocks being now getting dragged into the eye of the storm, what does one do here?
We've kept really to the private kind of retail banks rather than the corporate banks. So we continue to be happy in that space. As you know, I've been hugely negative on the PSU banks, and I can't see anything that's changed that. And if anything, now we're just waiting for the next penny to drop in one of the other banks, if that is the case. But there's no reason to rush. There might be value. You can say that there could be value, but I think that's what it's going to remain at the moment until we feel more certain that there's no other problems in the sector which can come and surprise us. So you don't need to be in the PSU banks. I think some of the corporate banks are starting to look more attractive, but again, I think let the dust settle a little bit, but might start nibbling away in some of the corporate banks.
Andrew, that's the problem though, isn't it? 35% of the weightage is now arguably in a spot wherein it's difficult for that pocket to attract large fresh money. Retail focused private sector banks, too expensive relative to the others. Corporate facing banks, probably attractively priced, but people are still in tenterhooks whether to bet on them or no. And every now and then they get caught into almost everything that the PSU banks are caught into as well. And PSU banks are anyways a no-no. How does this sector attract money?
It's the point where you say that, and I'm talking about the corporate banks, where that the valuations have taken to a point where it's pricing a lot of bad news, and so therefore you can start nibbling away at the stock. You don't have to go full in straight away, and see if your timing, you could be 5% too high, but as long as you get into it for the rebound which will come, then I think it's worth doing. And I think we all know that the next one quarter or this quarter ending is going to be terrible for all the banks. It's not it's not as though the RBI rules have not been known. It's been known for a few weeks now of what's going to happen with NPAs. So I don't think the market probably is waking up to that. And it really didn't do much in when the first news of the PNB fraud took place. It was really the PSU banks which were hit. So I'm a little bit more optimistic, and I say optimistic meaning cautiously optimistic, that the value is starting to come into the corporate banks. Whether today is the day to do it, I don't know, but it's looking attractive.
Viewers, keep in mind, by corporate-facing banks, I think what the general discussion points tend to veer towards are stocks like ICICI Bank, Axis Bank, and Yes Bank, amongst others. These are the ones which have a large corporate exposure, as opposed to banks like HDFC and Kotak, which also have corporate exposure but very high retail exposure as well, which is not as risky. Which is why you constantly hear these comments about corporate-facing banks, retail-focused banks, and the PSU banks. That's the distinction that you got to make. Keep in mind, ICICI Bank, as we speak, is the top loser, down about 3% at 285. And this is not the only day. I mean, the last 1 month, ICICI Bank has really taken it on the chin.
That's right, Neeraj. In fact, markets are still hovering around those levels of 10,200. But Andrew, two concerns, which majority of the FIs have been highlighting about the Indian markets in the recent past. A is the valuation; they are on the higher side, and B, the earnings growth. Though Q3 expectation was that the earnings growth could be better because of the low base we were staring at of demonetization. Companies like State Bank of India and a couple of other companies dented the Nifty EPS, I would call it, for third quarter. What's the sort of growth trajectory that you are now seeing for FY19 in terms of earnings, and what is your view on the current valuations?
So, I mean, current valuations are still a little bit rich, and we'd always like to see them a bit lower. But that said, for 18-19, we're looking at GDP growth of anywhere between 7 to 7.5%, and earnings growth of around 15%, which is the first time you'll see earnings growth in the past 4 years or so. We've always been disappointed. So I'm more optimistic on the earnings front than I have been for many years now. So I'm less worried on the earnings growth front. I'm more worried on some of the shorter term things that the market's kind of probably ignored, like the fiscal deficit and higher interest rates, which is all having this short term impact on sentiment. But once we're through it, then I think going into next year, then the earnings growth will support the valuations. And what I'm thinking is that rule of thumb is that markets should go up in line with earnings. So that's the kind of returns I'd be expecting. I mean, obviously, it's going to be a lot more volatile than 2017. That's for sure. And maybe that bull market in complacency, which we all had up until the middle of January, is probably gone for some time now, and that's no bad news either. So I think the reality of valuations is starting to, the high valuations, has played also a kind of a negative part in this fall. Are we at valuations which are kind of banging on the table, cheap valuations? No, and that's what foreign investors are citing as being part of the reason. But I think part of the reason, excuse me, is more global than it is local.
By the way, Minna Industries is down 10%, 1,050, and the Adani Group stocks are now looking very, very weak. Adani Transmission down 5.5%, Adani Enterprises down another 5% in trade today. I believe Adani Port too would be down. Adani Power, I'm sure, is not looking all that great. Adani Ports too down about a couple of percentage points, not looking all that great. Andrew, before we thank you, some of these usual suspects that tend to get battered down a lot when the markets come off, every rumor, however substantiated or otherwise, tends to impact sentiment on these. What does one do here? The Adani Group stocks, and there are some good names out there, or for that matter, some of the other group companies of groups which are slightly under a bit of stress.
It's some of these groups we haven't really invested in. Partly for the reason is that on when markets rise, these are the ones which also have positive rumors around them as well. And you just don't know when the negatives come for these. So the fundamentals for some of the companies are very good, and obviously we'll look at the valuations as they get hit on the way down, because they'll all be kind of pushed into the same boat, and the share price is falling. But I think at the moment there's other quality companies which I'd probably look to and concentrate my mind on, like I mentioned, the corporate banks, where I can see there's real value, for other reasons than just, negative rumors.
Yeah, I understand. I don't think there is a simple answer for this, Andrew, but I appreciate you trying to answer that question as well. But thanks for taking the time out and joining us today and speaking to us at Bloomberg Quint.
Thank you.